Thursday was a rough day for oil. It was a rough day for oil and energy stocks. Where's it going to go from Hill? Bill Baruch with iiTrader, Stacey Gilbert with Susquehanna. Stacey, wow, it was an ugly day for oil on Thursday once again. Many energy stocks falling as well. What's your view on either or both?
Right. So oil is one of those that's interesting. It's changed dramatically in terms of the sentiment. Over the last couple of months, it has been a 45, 55 range-bound type of market. As we approached 45, we saw the buyers come into the market. As we approached 55, we would see the sellers. The options market was consistent with that view, and it was almost without fail for the last, call it, 2.5 months. That changed this week, and we now see significant more caution and bearishness out there in the market. A lot of this weekly inventory data that has now come into the monthly numbers is concerning because it shows the production on the U.S. side is getting stronger. Demand is not outpacing it. It's not nearly as strong, and a lot of concern with China right now, which has just really changed the sentiment out there. So from that perspective, if you want to go sentiment-wise, I would say it's definitely more to the downside here in oil. All that being said, what are we seeing on the options side? We're starting to see it being priced in, the risk being priced in more on the equity side. We have started to see investors sell out of long stock positions and choose to buy calls in lieu of that. So that's what we call a stock replacement. Get some of the cash back for that stock, buy the call so you still have that upside exposure, but you have what's embedded in there. It's called the embeddedness of that call, where if it drops out, you got your cash back, you don't have any exposure, so you're limiting your downside risk there. So I think that's a good trade for investors who are still in it here.
Okay, Bill Baruch, what do you think? You agree with that?
I am bearish, and I remain bearish. I think there's a target down here about 44.06. Yeah, 45 is a psychological level, and we could see that. Long term, I like $40 to come into play. Now, the elephant in the room is OPEC over the next 3 weeks. What are we going to hear? What kind of jawboning are they going to have? Now, that could lift the market, and there is no straight line in this market. I think any rallies need to be sold. If you look back at November 30th, when the OPEC cut production, and they plan to cut it 1.2 million barrels, the U.S. has put on 600,000 barrels since then. And if you look closer to the numbers, 300,000 of that has come in the last 2 months. I think that pace can keep up, and what we'll see is 1.2 million barrels being made up by the U.S. by July or August. And this is going to be bearish for the market. I think any rallies need to be sold. But the key here as well is gasoline. And gasoline is below 150. The demand is not there in a seasonal time of year, and the market is cratering because gasoline is cratering. When this contract rolls from March into April in the futures, there's a gap between there, and that gap has already been taken out. That gap was not taken out at all last year, and this is very bearish. A close below 147 could bring a lot of selling.
Wow. Okay. Well, we're watching these levels, guys. I mean, oil just got real interesting again. Of course, I feel like we've been here before. Stacey and Bill, thank you both very much. Appreciate that, folks. Check out the live version of Trading Nation on CNBC's Power Lunch. I'll see you there as well. Take care.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.